My name is Jim Mitchell. I'm the president and founder of Mitchell Financial Services, B&M Tax Services, and NWM Tax Services here in Bellingham. And one of the things that I'm going to share with you in the next many weeks to come is how we can give you ideas that can help make you better at what you do with your own financial advisor. You're going to find these the things that we share with you are going to be fun, interesting, and more than anything else, it's going to make you a lot of money. And we're going to help you find money to help you increase your retirement, the benefits that you're going to provide for your family, and money that you can make by just knowing the current tax laws. Now, the first idea that I'm going to share with you is a pretty simple idea. We've used this for years and years. You can take this idea to your tax and financial advisor, and they should be able to help you use this so that you can end up with a significant return on your investments. What's happened in the last few years in the market? The market's gone down, hasn't it? A lot of people forget the fact that if the market goes down 40% on $100,000, you've gone down to $60,000. And if the market goes up 40%, it's 40% of 60, not 40% of 100. You're only going up $24,000. So as a result, a year later, you're at $84,000 if the market went up 40 one year and down 40 the year prior. So what can people do to get inspired about putting money back into savings again? I'm going to share with you a concept that we very simply call the Snowball Effect. One of the advantages is if you've ever been out in the snow on a beautiful winter day and the snow is about 31, 32 degrees. It's easy to throw snowballs, pack snow, make snowmen, but you know how difficult it is when it gets too cold and obviously if it gets too hot. So what you want is just kind of a perfect situation to where you can look and see what your investments are doing. Now, let's say that I'm working for an employer and I have a 401k available. And let's just say right now it has no matching money. He just has it available. I can put into a 401k. And in this case, I have at least $5,000 sitting in the bank. Okay? And I'm saying, I wonder where that should go. If I leave that in the bank, oh, gosh, I'm making 2% interest if I'm lucky. Okay? But what if I could show you how to make 33% or more guaranteed on your money this year alone? Now, that's what a 401k, an IRA, a TSA, or a SEP could do for you right now. And when you see this idea, you need to go to your tax advisor and go talk to him about absolutely putting one of these together. And then you go to your financial advisor and he can help you with the paperwork. Number one, let's say you've got $5,000 or $400 a month that you can put into a IRA or a TSA. Number one, we're going to call this Snowball Effect, because it just keeps on going. And more than anything, you'll be surprised at how simple it is. Okay, number one, you know that if you leave it in savings, you've got $5,000, and plus at 2% interest, you got $100. If you're in a 25% tax bracket, you lose $25, so you got $75. Not a lot of money in terms of interest, okay? Using the Snowball Effect, here's what you'll have, okay? Number one, if you put this into a TSA, an IRA, or a SEP, basically you're going to save 25%, and assume you're in a 25% tax bracket, okay? You're going to save $1,250 in taxes. Now, if you're working with a tax advisor, they can help you change your withholding. Now, what does that really mean? That means that if you decided to move from your savings account into a 401k, they can help you reduce your taxes so that you don't have to put that money out and take that tax savings and reinvest it. If that's the case, basically, you have $1,250 now that is also going to go into your investment. Let's just say it's a 401k for right now. Okay? Now, because you took that tax savings and you put it into the 401k, what's going to happen? Well, guess what? you're going to save more taxes on that. So if you took 25% of the $1,250 you saved from putting the $5,000 in, you're going to save at this point another $313. Okay? Now, you have $313. You're going to put that now into your 401k, and that's going to save another 25%. And that's going to save $78. Okay? And then we're going to put that into your 401k, and it will save another $20. Okay? Now, the total that you're going to save is $1,666. Okay? That's the total amount that you've saved from being able to take your $5,000 and put it into your 401k. You picked up an extra $1,666 that you can put immediately into your 401k. Now, if you take that $1,666 and you divide that by 5,000, you have a 33% rate of return. Now, let's say you put that into an investment that gets 4% interest. Add the 4% on there. How much did you make last year by putting that into your 401k? Where else can you go and invest money and get a 37% return, okay, without any risk? 33% guaranteed. So take the money that you have and start putting it back into your 401ks. Please understand that these numbers haven't changed for the 40 years I've been in business. They're the same now as they were then. I used this years ago just to help teachers be able to learn how to put money into their tax-sheltered annuities. They're allowed to put as much as you put in your 401k into their tax-sheltered annuities, which is the same thing, only it's taken out of their income from the school district. Now, remember that when you look at retiring, sometimes you need to find an incentive that's going to give you the reasons to change and add to your 401k. Now, obviously, let's say that you were getting matched money in this 401k of, I will use a high number. I'll say 50-cent match for every dollar you put out. Okay? Well, my gosh, how much did you make there? Well, you can take 50% of that, and 50% of that, you've got $2,500 and another $800, so you've got $3,300 in addition to that. You add that and divide that by the 5,000, you come up with an unbelievable number of about 87% return if you have match, or 100% return, because that's money you didn't even have before. Okay? If you're not participating in your company's 401k, you need to. If you're not doing a TSA or a deferred comp with if you work for the city or the state, you need to consider doing that. Only people that don't understand this concept don't do it. So I want to take the time to thank you very much. I hope you like this little idea, and I'll be back with a whole bunch more. Thank you.